Company executives and market analysts always talk about the bottom line. What exactly is bottom line? Why is it called the bottom line? Hello, I'm Dennis the Wong Man. Today, let's take a look at the bottom line and how we investors should understand it and use it. In business finance, the bottom line refers to net income or net profits or net earning of a company. And they are quite often used interchangeably. And because it always appears at the bottom of an income statement as the last line, that's why it's also called the bottom line. Well, let's take a look at a business financial statement. And let's go to the income statement, right? What always appears at the top of an income statement is sales or revenue, which is also called the top line. Now, we talk about sales, revenue, and order in the previous video. If you miss it, go check it out. Sales and revenue is one of the very important elements of any given business, because if a company is not able to generate sales and revenue, there's no business there. And once you're able to generate the sales and revenue, from there you subtract all the business expenses. And you also subtract any depreciation such as equipment or plant. And at the end, you subtract all the taxes that you're supposed to pay. And the remaining is your net profit or net income or net earning. That's what appears at the bottom of an income statement. And once you take this total earning divided by the total number of outstanding shares, and then you will get the earning per share or EPS. And earning per share or EPS is what we as investors, we always look at because it reflects the profitability of a company. Since the bottom line is the net profit, so the higher the better for business owners and also shareholders. So how do we increase the bottom line? Well, typically, first by increasing the top line, the revenue and sales, through acquiring more customers, selling more products and services, or selling it at a higher price, at a higher margin. Right? That's very, very important in generating higher profitability or the bottom line. Another way is through decreasing expenses, cutting unnecessary business expense, reducing workforce, laying off employee. That's why, during hard time or downturn, economic downturn, you would hear that corporations, they're laying off employee, cutting expenses in order to preserve, their bottom line. It is a tricky balancing act because if you're laying off too much or cutting too much, it actually hurt the productivity of a business. And that would reduce the ability to produce the top line, which is sales and revenue. So it requires some very, very skillful balancing act of financial management. Although the bottom line is not the only thing that we look at, earning per share or EPS is certainly a key metric we always analyze. As investor, we always expect a company would produce a positive earning or EPS, which means the company is making profits. Not only 1 year, but year over year consistently. And we would also expect the earning or EPS would grow consistently. And as value investor, we're looking for a company that would consistently growing at least a double-digit rate. Very soon, many companies will be releasing their annual financial reports. And you'll be able to see or find out the net earning at the bottom of the income statement. Now, you may wonder, hey, where does those net earning go? Those net profits? Where's the money? Show me the money, right? Here's the typical way where the earnings will go to. Number one, some company may choose to pay dividends, pay a portion of that net profit or net earning as a way to return capital to shareholder. Now, typically, they would only pay a portion and reserve the rest for other usage. And what else? Number two, they may spend a portion of it to buy back shares. And buying back shares is another way to return capital to shareholders, which will benefit shareholders like me and you. We will discuss share buyback in a separate video, so stay tuned. Number three, They may choose to spend it on the so-called capital expenditure for growing the business, such as expanding their facilities, expanding their manufacturing facilities, purchasing new tools, new equipment, so they can grow the business. So those are capital expense for growth, expansion. And then the remaining of those earning will be kept in the company and is called retained earning, which will be shown on the balance sheet. The retained earning on the book belongs to shareholder. It would be there and stay there either for future use or future distribution to shareholder. I hope this video helped everyone understand the bottom line. If you would like to learn more about value investing in the Warren Buffett way, join my Facebook group. I will include the link below. In this group, we will learn, share, and support each other in learning to invest safely and wisely. And we will have regular posts and share more information like this. If you enjoyed this video, please subscribe and share with others. And don't forget the like and notification bell. And I will see you next time. Take care.